Good afternoon, ladies and gentlemen, and welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Sarah Petoskey. Please go ahead, Ms. Petoskey.
Good afternoon. Thank you for dialing in to the Barometer Readings Monthly Conference Call. My name is Sarah Petoskey, Regional Vice President of Sales at Barometer, and I would like to thank you all for your continued support. Since our last call, our models continue to point to an expansion in market breadth and clear leadership themes evolving in sectors such as energy, industrials, and technology. In addition, we are now seeing strong earnings growth in conjunction with PE expansion. This has not been seen for years until about 18 months ago, setting up a very constructive environment, an environment that our portfolios are set up to take advantage of. Performance continues to be strong across the Barometer portfolios as our investment thesis plays out. To highlight a few, the Barometer Income Fund is up 7.8%. Our Barometer Equity Fund launched this year is up just over 10% year to date. The High Income Pool up 6.6%. Our Global Tactical Balance Pool up 8.1%. The Equity Pool up 7.6%. And our Long Short Pool up 10%. Joining us on the call today is David Burrows, President and Chief Investment Strategist, along with Salman Malik, Portfolio Manager. Dave will highlight our constructive market breadth indicators, and Sal will speak about some of our energy infrastructure names, as well as recent M&A activity in the market. With that, I'll pass it over to Dave.
Hey, folks. Thanks for taking the time to dial in today. Weather's getting nicer out there. People are making some shorter days, but in general, it appears that people are pretty busy. So just from the top, let's talk a little bit about macro top-down. Earlier in the year, I think there was a view that the market was set up for some kind of correction that was not panning out in the indicators that we look at. While the market did shop around a little bit through early March and April, and there was a pause in leadership in some of the higher beta, higher growth names, breadth models stayed firm all the way through. World bullish percent varied by about 2% over that 2-month period. Short-term indicators gave us a little bit of a yellow flag, but none of our positions really were significantly impacted. We stayed invested through the period. And as we've said before, corrections come two ways. They come in time or in price. After the market consolidating sideways for about 2 months, S&P broke out, made a new high. TSX made a new high. All the major consumer-led economies in Europe made new highs, and the measurement now is a fair ways higher. Off the charts, it looks like there could be as much as 15% upside in Europe. U.S. looks like there could be another 7 or 8% upside. NASDAQ is similar. Russell 2000 is similar. So all of our short-term indicators as of today are positive. Looking at the percentage stocks above the 50-day moving average, percent of stocks above the 200-day moving average, percent of stocks with positive price momentum, that's been firming up now for 2 months. And the percent of stocks hitting new highs versus new lows. Bullish percent for the major markets, which is our major market risk indicator, has been improving and is seeing an increased number of companies with positive price trends. Globally, about 56% of stocks are participating in this rally. That is about the high point for this rally, but still well below 70 or 80%, which would mean the rally was getting long in the tooth. So we are quite comfortable with the way the market is behaving. When we look at what may be driving things, profitability is good. This quarter has seen more upward revisions and fewer downward revisions than any quarter going back to 2009. Leading indicators are improving, and so in general, things look quite strong. Regionally, consumer-led developed countries continue to lead, while there was some rally in some of the emerging markets. relative strength has yet to reverse up versus developed markets. In fact, it looks like it's rolling over a little bit. After a small rally in some of the commodity sectors, it looks as though they are waning a little bit. The one commodity that has shown good improvement is energy, and we'll talk a little bit about that in a moment. So, as we've been talking about for some time, we believe we're in an environment where not only we get earnings growth, but get PE expansion. That's been going on now for about 18 months. That's exactly what happened in the 1990s to give us a geometric lift in share prices. And like other secular bull markets, pullbacks have been shallow, 3, 4, 5%. And we know that we are seeing investors buy the dips. Investors continue to be underweight equities. We're now really only about a year where we've been seeing flows back to equities from fixed income. It's not rushing from one to the other. It's just slow, steady migration, and that's what we'd like to see. So as we are in the portfolios, we're constantly trying to work our way towards strength. Over the last 3 or 4 months, if you've been following our weightings, slowly the energy weight has been rising. To build on top of our infrastructure theme, which has been a key theme for the firm for the last 4 years, we have been increasing our exposure to exploration and production companies, both in the U.S. and Canada, and also to service companies. That's been the biggest significant add to the portfolios. If we were to look sector to sector from a relative strength standpoint over the last 2 months, the 3 big sectors that have seen improvement relative to the rest of the market would be energy, followed by technology, followed by industrials. So as I think you know, we're all about trying to find secular themes where there's some change taking place that could lead to a revaluation. While the energy infrastructure was a big investment for us initially, E&P and service companies have become much bigger. And the driver really behind that has not been so much about expecting oil prices to go a lot higher, although technically it does look that that's the case, but it's been more specifically that the cost to find new reserves and lift oil has been falling steadily. And this is just simply mass manufacturing. In the U.S., we have in 4 years replaced 4 decades of declining production. And in the month of April, you may have read in the Financial Times, U.S. produced more oil and gas in the month of April than any month, including the peak year of production in 1970. So they are back at new highs for energy production in the U.S. The U.S. is now the largest oil producer in the world. And we think this has profound impacts on consumer and on the economy in the U.S. going forward. So it makes sense that alongside of the energy, industrials are doing particularly well. Industrials obviously dependent on secure source of energy. A lot of capital investment taking place in a number of industries. One in particular that we've talked about for some time is chemicals. You may have seen an article over the last 2 weeks about Sasol out of Europe planning to build a $23 billion industrial city in Louisiana to take advantage of cheap gas prices. To put that in perspective, Louisiana measures its economic growth in hundreds of millions of dollars. One company investing $23 billion to create 7,000 jobs is significant, and that's simply to take advantage of $4 gas in a world of $16 gas in Europe. Industrials certainly have been performing well, good relative price performance. We're seeing lots of ideas. So energy, technology, and industrials would be our biggest weights and the sectors that we've been focused on. In financials, because it appears that rates could stay lower longer, we've been reducing our exposure to insurance, but increasing our exposure to asset management. With net equity flows coming in and performance driving equity assets under management, asset managers continue to perform well. We've got a number of companies within that space. So in the income portfolio, if we look at it today, energy makes up just about 40% of the portfolio. As I mentioned, that's a combination of infrastructure producers and service companies. Financials make up about 25%. That would be banks and asset managers primarily. Industrials make up 8%. Technology makes up 5.5%. The lower weight in technology and industrials has to do with the fact that there are fewer yielding names in those sectors. If you were to look at the equity portfolio for the equity fund, 37% energy, 18% technology, benefiting from more capital investment. Industrials make up 15%, consumer discretionary makes up 12%, financials down to 11%. So overall, portfolios are fully invested. The income portfolio a little bit more skewed towards Canada because energy and financials can provide us lots of opportunity in the Canadian marketplace. In the equity portfolio, a bigger weight in the U.S. to take advantage of technology, industrials, and healthcare. If you look at some of the key factors, it looks as though multiple expansion could go on here for a long time. There's a lot of money continues to be stranded on the sidelines, and the underlying conditions continue to improve. I want to get Sal just to talk for a minute about M&A because so far this year in the S&P, M&A is up over 70%. For the last couple of years, we've seen capital used two ways. We've seen dividend increases, and we've seen share buybacks. Dividend payout in the S&P is still below 34%, way below the long-term average of 50%, and certainly way below the highs seen in the 1950s and 60s at 60 to 70%. Cash continues to hit new highs quarter over quarter. Last quarter, S&P 500 companies reported record cash on the balance sheets again. And so we're starting to see, based on the very low cost of capital, a lot more M&A, which raises the question, for those that think the market's expensive, why is it that companies look strategically and think they can make acquisitions and have them be accretive, and at the same time, when these deals are getting done, the market is applauding and the acquirer's share price is going higher. So Sal's going to talk a little bit about that, and then we'll come back.
Hey, thanks, Dave. I guess two good examples would be Baytex, when Baytex did that deal with Aurora, where they acquired production in the Eagle Ford play. Market really liked that, and we saw Baytex stock do quite well since they issued the receipt because it was accretive on a per-share basis. They were able to increase their cash flow per share by 18%. Similarly, one of our key position in income strategy, it's called Williams Corp. It's a midstream asset company in U.S. Yesterday, it announced that it's acquiring 50% of the stake that it did not own in the ACMP MLP. Once that was announced, because Access had all of its cash flow coming from fee-based business, and Williams had only 70% coming from the fee-based business. This deal enabled them to reduce their commodity exposure, which is basically the frac exposure, to down to 20%. Market really liked the deal. And in this case, the acquirer actually traded up 18% because by doing this deal, they were able to announce a 32% dividend increase in Q3 of 2014, whereas earlier they said they will be able to do that at the end of 2015. And they were also able to guide a 15% dividend increase every year for the next 3 years going forward. So we have a very significant position in Williams, and we're quite happy that this has worked out. And even at current level, it's trading at 6% 2017 dividend yield. So from our opinion, we believe that there's significant upside. If it starts trading at a similar valuation where other general partners of MLPs in U.S. are trading, they're trading around 3.5% dividend yield. Williams is trading around 4.5%. If it goes to 3.5% 2017 dividend, which is $3.25, the stock could be worth around $85 to $90. Currently, it's trading at $56. So we really like this name. And with this, I'll pass it back to Dave.
Great. So as we go into summer here, we talked on the last call, while I think people get concerned seasonally, leading indicators were moving higher into summer. Breadth models continue to improve. Equities relative to other asset classes continue to be inexpensive. Flows are certainly supportive. Market is behaving well given the news in the marketplace. We continue to be quite bullish. If you were just to quantify it, dividend growth in the S&P this year looks like it'll be somewhere around 10%. We're certainly getting more than our share. Our goal is to find companies that are good, getting better, with an improving ability to pay. So far, the dividend growth we're seeing in the portfolio is just over 15%. That's building on top of just under 10% dividend growth last year. If we can continue to get yields that are competitive in the 4 and 5% range and get dividend growth of 15%, we think this is a very attractive bucket to focus on for money working its way out of 2.5% 10-year bonds. The equity portfolios give us the ability to focus on securities that are not yield-focused, and given that it's a targeted strategy in a world of falling correlations, it sets up well. In the 1990s, this was a very good place for us in equities. They're shaping up again this year. When we look at returns, the Dow is up about 1.4%, the S&P is up about 5%, NASDAQ's up about 3%, Euro Stoxx 50 is up about 5%, DAX is up about 3.8%. Equity portfolio being up 10% looks really good. Income portfolio being close to 10% also looks really good. We're very happy with the way the portfolio is setting up. I think it's not hurting us. Some of the geopolitical in Iraq having a bigger energy weight. Understand it's not why we're there. We're there because we believe volumes are going up and finding costs are coming down. With that, I think we could wrap it up and answer questions. But operator, if there's any questions, we're certainly happy to answer them.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Again, if you would like to ask a question, please press star 1 on your telephone keypad. Your first question comes from Michael Wilson. Your line is open.
Hey, David, it's Colin here working with Mike.
How are you?
Good. I just saw you took down some of that Prairie Sky in the equity portfolio. Saw it had a good run. Just kind of wondering what your thoughts were on it.
Hey, hi. So, there's scarce amount of royalty assets out there. So Prairie Sky gives you a good exposure to a long life asset, and given that it was within the Encana portfolio and no one was focused on that, we believe that now that it's a public company with independent management team and an independent board, the opportunity to grow the current production is good. Plus, there are some assets that are in the private market, royalty assets. We think that Prairie Sky will be looking at those assets because if they can acquire them using their valuation, they could be quite accretive. So we expect 5 to 10% dividend increase on an annualized basis going forward from Prairie Sky, and it has a 3% yield. So we believe it provides you good double-digit return as long as we have a constructive view on the underlying commodity. So we like the name.
Great, thank you.
Again, if you'd like to ask a question, please press star 1 on your telephone keypad. There are no questions at this time. I now turn the call back over to the presenters.
I just wanted to thank you again for taking the time to join us today. And I apologize, my performance didn't include yesterday. So our income fund's up almost 9%, and the equity fund up 11%, and the pool up 7.5%. So it's a bit more current performance. Our next monthly conference call will be held on Tuesday, July 22nd at 4:15 Eastern Standard Time. As highlighted today on the call, we feel this is a great environment to put money to work. There are a number of catalysts leading to multiple expansion that we continue to observe in income and broad equity securities. please do not hesitate to contact Kayla Peacock, Nick Hamilton, or myself for any recent performance data, portfolio positioning, marketing materials, or any questions you may have. Thank you again, and have a good night.